Welcome to chapter 17. We are more than halfway through in this book club where we are going through macroeconomics. Chapter 17 is the first of the four chapter that talks about open economy, meaning an economy that trades with other economies. So far, we have assumed closed economies up until all of the chapters before. And so that is not the case for most countries. A lot of countries freely import goods from other countries and export goods to other countries. So let's evolve our understanding and understand how does what we've learned so far change when the economy is an open economy. And so we will look at two aspects: goods market, how does that impact if the economy is open, and the financial market, how does that impact the country when the financial markets are open. All right, the key takeaway from this entire chapter is that in an open economy we need to think about new choices that investors and consumers have. Yeah, two new choices. Up until now the choice was simple: you just buy what is produced locally. But now with an open economy you can decide as a buyer whether you want to buy domestic goods or you want to buy foreign goods. Yeah. So that's the first set of choices. And the second is whether you want to invest in an asset that is a domestic asset of your current country or in an asset of a foreign country. So that is interesting, right? Because now all of a sudden the world is open. You can buy things from somewhere else and you can buy assets that produce interest from some other country. Yeah. So those are the two aspects. Let's quickly look at that and understand how, to start with, how does openness impact the goods market? So the first example that comes to mind is the North America Free Trade Agreement, or the current United States, Mexico, Canada agreement, which in a sense is an agreement to remove all kinds of tariffs, yeah, all kinds of trade barriers, so that goods can move freely between these three countries in North America. Yeah, and so when this happened, reduction in tariffs and other barriers leads to, you know, Mexican avocados moving freely to United States, and United States building supply chain with Canada for certain parts and becoming more competitive and be able to compete with China, let's say in the auto industries and so on. Yeah. So this is an example where openness or free trade between these three countries in North America help them all grow. Yeah. So when there is an open market, um, and a lot of countries have open market agreements, um, and they are open in the sense that they import and export. But it is also true that each of these countries also engage in tariffs, quotas, and capital controls. Yeah. So take a look at this chart. What we see is that the world growth and the advanced economies growth and the developing or the emerging countries, they move in the same fashion, but with a different magnitude. Yeah, we saw during the GFC, the Great Financial Crisis, everyone tanked, and similarly during COVID, the magnitude is different, but they move together. It also shows how much of connection now there is between open openness and how they impact each other. Yeah. So let's also quickly remember that tariffs, quotas, and capital controls, while the countries are open, they still engage with some level of tariffs, which is, in a sense, taxes on imported goods. It could be a fixed amount, or it could be a percentage of the item of the good, or a percentage of the value of the good. Yep. And quotas is restriction in quantity, like how many you could import. And capital controls is restriction in how much capital can be moved in and out, right? And so these are put in place for various reasons. And to really understand, and these are barriers per se, yeah, it doesn't give you full openness. If a investor wants to invest all of their money outside, but they can only take 2% of, let's say, their net worth every year, then that is a lot of time for them to be able to take all of their money outside. So capital controls, quotas, tariffs have a huge impact. Tariffs improve government revenue at the expense of consumers who end up paying more. Yeah, and quotas have restriction on quantity. Again, remember, depending on the price elasticity of demand of these goods on which these controls or these barriers are set, you will see different impact. So while we understand that there's open economies, there's still countries engaging with some amount of tariffs, quotas, and capital controls so as to preserve the competitiveness of their local industries and be able to negotiate. That's what the current setup is. But um, so we understand this briefly. Let's also see how United States have almost 3x'd the export in the last 60 years. Yeah. So if you go here, if you take a look at this export, it's about close to 5 and now close to around 15. Same for imports. Imports have grown slightly more than exports, but almost triple, 2 to 3x roughly. Yeah. Which tells you how much the country is dependent on external imports and also dependent on revenue from exports. Yeah, so a proxy of openness could be looking at this percentage share. Yeah, in this case, we see exports as a percentage of GDP or imports as a percentage of GDP. It's about 15, 16% and about 11% for exports. Yeah. Um, and remember, you can only export things that are tradable. Yeah, not uh, goods that are not tradable. Yeah, so goods that compete with foreign goods in either domestic market or foreign markets are tradable goods. So this is a good way to measure a proxy of openness. While United States is, this is 2022 numbers, exports about 12%, it's still at the low end of export ratio compared to all of these countries. But remember also, the United States is a much bigger country when it comes to, let's say, comparing to Netherlands or Switzerland and so on. Yeah. And what we see distinctively is that some of these ratios are less than 100%, but it could be way higher than 100%. Example, Singapore. Yeah, it has always been, since what we see in this chart from the World Bank data, exports as a percent of GDP is 180%. And 165 was the low base in 1990, 1990s, and now it's gone all the way up to 225, which is pretty massive. Yeah, and the reason why they're able to do that is because they are intermediaries. They import a lot of things, they're pre-processed, they process, add value, and then they export. An example being, if they, let's say, import $100 of goods from the United States, they add a lot of value to it, and then they sell it for $110 to Malaysia. Then the export to GDP ratio, or the value add is 10, so GDP in this case, let's say it's 10, would be 11. So 110 divided by 10, so this would be close to 11. But in this case, we see export GDP ratio 165 all the way to 225. Yeah, so they are intermediaries in trade. They're very, very small island country. And so um, they depend a lot on imports, and then they depend a lot on exports and huge value add. And so if you look at exports as a percent of goods, you have to also look at that from that lens. So now let's understand nominal versus real. Yeah. And what is the difference between that one more time? A nominal rate is when you look at the relative value of currency, yeah, between one country and the other. And real is relative value of goods. So let's say if I'm an American and I want to go to United Kingdom. And I'm thinking whether I should buy this item that I'm really interested in buying in the US, or should I go, I'm anyways going to the UK, I'm going to go buy it from there. So what you do is in your mind, you're thinking, if you're buying a real item, a real good, then you would want to look at a real exchange rate. And the way it starts is you look at the price of good, let's say a phone, I'm trying to buy this iPhone in the United States, and then you look at that price and you compare that price to the price that you will get in United Kingdom. So what you do is you look at the price in United Kingdom, and that is P star, and you also will then convert, let's say the price of US dollars, price of this item is P, you would convert it into pounds. So you would get E times P, E is the exchange ratio. So every dollar you give, you get some pounds. So you convert the price into pounds, you get E times P, and then you compare that to the price in pounds in UK. So the exchange ratio, price of US goods in terms of UK goods, is the real exchange rate. Yeah, so simple example of an iPhone. So we get the exchange rate is exchange ratio is exchange rate times the price in local currency, domestic currency, divided by price in the foreign currency. Yeah, so that's a way to understand real exchange rate. Yeah, and what we see is that nominal exchange rate, which is in this pink color, has gone up, but real exchange rate has started to converge between US and UK goods. Yeah, so I looked at one item, in this case the iPhone, but you'd want to look at the basket of goods, and a good indicator is the price level, because that factors in the price of basket of goods. Remember, the price level itself doesn't give you a lot of information, but the rate of change of price level does. So you know how it's changing over time, and that's one way in which you can compare real price of goods in United States versus United Kingdom. So again, nominal exchange rate is price of domestic currency, US dollars, in terms of foreign currency, pounds. Real exchange rate is price of domestic goods, United States, the price of the iPhone versus the same iPhone in United Kingdom. And for that, you'd have to do this conversion and then compare. So you get the real exchange rate. What you see in the newspapers most of the time is nominal exchange rates. So you'd want to be careful, because it just tells you the relative prices of currency. And if you want to compare real exchange rate, you would do this math, like I gave an example. Or if you're a tourist and thinking, oh, how much would be the cost of my vacation in United Kingdom last year versus this year, you would start to think about, like, okay, how much would it have cost me if I converted the dollars, got all of those real goods, and then enjoyed those goods and came back that time, this time, and then again, there's time value, money associated with it. But you would want to look at real terms to find out how much real goods are you able to enjoy. And so now when we're thinking of currency, we look at United States dollars and UK pounds. But let's take another example. United States dollars and Indian rupee. Yeah. And a third example, United States dollars to United Arab Emirates. Yeah. Dinar. So you start to see that here this is a fixed exchange rate with the United Arab Emirates. And here it's a floating exchange rate, depends on market supply and demand. And what we see is that the Indian rupee has depreciated, or the US dollar has appreciated, meaning a US dollar was able to get close to $70 somewhere around 2019, 2020. Now it's able to get close to 88. So a US dollar has become appreciated or stronger. It can buy more of Indian rupees. And similarly, when a currency appreciates in front of the other currency depreciates in front of the other currency. Yeah. So understanding appreciation, depreciation, which impacts the currency here, which is floating, meaning depends on market supply and demand and various other factors. But if you have a fixed exchange rate, then we have this thing called currency evaluation and devaluation and revaluation. Revaluations increase, um, and devaluation is decrease in exchange that come about. Yeah. So depending on what you're looking at, you would want to look at appreciation, depreciation of currency, or revaluation and devaluation of currency. And what does that tell us? Yeah, look, the factors that impact currency appreciation, depreciation are many, but we will learn in this chapter interest rate is one. Differences between one country versus the other is an important one. But again, remember, what is the supply and demand of Indian rupee, um, and what is the supply and demand of US dollar? That has a huge impact. Some market forces has a huge impact on appreciation, depreciation. At the same time, what is the expected growth between these two countries, and also expected inflation between these two countries? How stable are these two countries from a long-term duration? That also has a huge impact on currency. Trade deficit, trade balances, um, the fiscal policy, investor sentiment, risk appetite, and many more factors impact the currency. And we look at one aspect in more detail today, which is the interest rate differences between two countries. Yeah. So when we look at two countries, we look at bilateral real exchange rate. But what if United States just doesn't deal with one country, deals with 15 other countries? So that's when you need a multilateral exchange rate. Yeah. So we looked at one country, one example, but we want to look at the weighted average of exchange from all the goods and services of the top partners. And so that's where multilateral exchange rate comes in. Um, and that factors in all of the countries that the United States does exports with. Yeah. So if you extend that, you will get um, you will get multilateral exchange rate. And so for that, let's find out um, where is United States exporting and importing. So it's exporting, percentage of exports to Canada is 18% and imports 14%. It's exporting more. Um, and then look at this one. It's exporting only 7% to China and importing 13%. This is one of the reasons of this tension between the two countries on growing trade imbalance. And also, if you look at the combination here, the top three partners, Canada, Mexico, and individually China, but then European Union combined has 18%. Yeah, so if you look at this, then you know what United States does exports to and imports from, and then those currencies have an impact in terms of real exchange between goods being competitive of United States in United States and outside of United States, and goods that are exported into United States or imported into United States are competitive or compared to local goods and services. Yeah, so multilateral exchange rate is another a very important aspect. And if we see how the multilateral exchange rate has evolved, and you can look at this data from the World Bank, it has its peaks and troughs and peaks and troughs, and these swings are pretty high, and it depends on how much is the trade deficit, economic activity, demand and supply of US dollar. We looked about various other factors. Um, and so in an aggregate, what is the exchange rate in real terms, yeah, of United States dollars. One thing that really impacts this is balance of payments. BOP, balance of payments accounts, consists of a set of accounts, two, current account, and the financial account. The current account includes all of the exports and imports. So that gives you the trade balance. A negative trade balance is a deficit. A positive trade balance is nothing but exports minus imports. So negative trade balance would be a deficit. Positive trade balance would be a surplus. Yeah. And so that is just goods and services. Yeah. Exports minus imports. And we also have income that United States um, owns, and then outside of United States. So we get income from, let's say, holding external assets outside of the United States, we got 1.405, 1.405, and then we had to pay those foreign asset holders who hold United States assets. So we have to give them income. So income paid. So net income is about $21 billion. And so then that means that we had X trade balance of goods of 972, and then another negative 21 of net income. It gives us about close to $1 trillion of current account balance. I think these numbers are 2022, and that's one aspect, yeah. But then what that means is that this has to be funded by someone, yeah. We are in deficit, yeah, of $1 trillion in this case, assuming all of these numbers are in billions of dollars. And so what that means is that foreigners started owning more of US assets. So these are mirror image accounts. These are called above the line and this is below the line. And so what we see is that there's an increase of $1.5 trillion of foreigners holding US assets and about $760 billion of US holding foreign assets. So that gives you a net of 804. This has to be very close. This number, financial account balance, should be equal to current account balance, but in an opposite way. Yeah. So whatever this is should be equal to the negative of this. But there's this discrepancy. So if you add both of this, you'll get this one. Yeah. So it's just measurement differences, which is pretty large actually. Close to 20% statistical discrepancy between financial account and current account. So think about financial account would be is in surplus, yeah, and current account is in deficit because financial account funds the current account, yeah. And so, and when this is in surplus, this would be in deficit, and so on and so forth. So you know what's happening. In this case, foreigners are holding more of United States assets and investing into United States by funding this deficit per se. Yeah. So we looked at current account and financial account, which together constitutes balance of payments. And above the line, which is this line that I just drew, would be current account. Below the line or financial account. Yeah. And we looked at when this is in deficit, this is in surplus. And you may also see financial account, also called as the capital account. So current account and capital account, but we call it financial account or the capital account. Yeah. All right. So that tells us that. And then this 21 number is if you remember, the GNP is GDP plus net factor income. Yeah. So that is the 21 billion here. An example of a country that runs huge current account surplus. We looked at the United States, which current account deficit. So Kuwait, 1989 to 94, had a huge current account surplus that it ran. Especially when oil was discovered, they decided that they don't want to spend all of the revenue from this newfound oil, but want to invest in foreign assets. So they are able to invest in foreign asset, and so that can pay for the future Kuwaitians who would benefit when the oil runs out. So they ran current account surplus, which was funded by the capital account deficit, yeah. And so that's one example of that. So we looked at goods market openness and how it impacts. Now let's look at financial market, because as an investor, you could decide to invest locally or invest externally in abroad in a foreign country. And when you do that, you're able to do that when there is an open financial market. So let's say if you were to invest in US bonds and you had $1 to invest, you would get 1 plus IT a year from now, which IT is the interest. But you also could invest the same dollar, convert it into UK, so use the exchange rate and convert the dollar and get pounds, and then you would get the interest rate that's given by United Kingdom, and you would have 1 plus IT then. So you could do that too. And so in your mind, if you're rational, you would expect to invest in a country where there is maximum return. Yeah. And so, and you also have to adjust for risk, yeah, because you're converting currency. You're getting this, let's say, higher return here, but then at the end of it, you would want to compare how much this return is back into my dollar. So you would take the dollar, convert to pound, get the pound return converted back to US dollar. So that gives you dollar return if you were to invest in UK pounds. Yeah. So it depends on the exchange rate a year from now, interest rate offered by the UK government, and the exchange rate when you convert it in year zero, and then exchange rate converted year one. So there's an exchange rate difference, and there's uncertainty associated with that. And so that's where this really interesting concept called uncovered interest parity or interest parity condition, which basically says that you would not have hedged, let's say, and there's this other aspect called covered interest parity, but let's say uncovered interest parity is gives you a way to find out the relationship between interest rate and exchange rate. Yeah. And it assumes that as an investor, you would expect the return that you get from you would be you'd be okay investing in either as long as you get the same return, right? And so, and the risk of exchange is factored in. So uncovered interest parity condition provides this understanding relationship between interest rate, yeah, and exchange rate, and assuming investors are rational and can predict with accuracy what the future movements are going to be, and it ignores transaction costs and risks associated with this conversion here and all of that, right? Because anytime you convert a dollar to pound, you will pay some fees. You will get some transaction costs associated with it, which is fees, and then back. So you already lost some money there. So the conversion and investment here should be much higher, return should be much higher for you to do all of this back and forth. Um, Maybe also comply with the regulation and all of the risks that are associated with not being able to move the capital when you want it, and exchange rate fluctuation. So, but it at least gives us a clear understanding, a framework to think about what is that relationship between what I get in US terms and what I get in UK terms. And if you approximate it, you would know that interest rate that I get here would be equal to the interest rate I would get in a foreign country minus the depreciation of the currency. Yeah. So an example of this, so that's the way for you to compare interest rates. Yeah. You shouldn't just compare interest rates in foreign country with interest rates in the local country. You'd want to remove depreciation from it. So that's the intuition behind it. So domestic interest rates must be equal to the foreign interest rate minus expected depreciation of domestic currency. Yeah. And so that's what you expect. Otherwise, if there's arbitrage, people will just move away from one country to another country where there's an arbitrage difference. So assuming arbitrage, we would expect this to hold. So now let's take an example, make it real. As of right now, February 2025, we see that the India 10-year bond is providing a yield of 6.75%, and the US bond 10-year is giving you a 4.48%. But let's imagine that you're in the year 2020, somewhere here, in the depth of COVID crisis. At that time, the US offered you 0.6% 10-year bond yield, and India offered you 5.75%, somewhere here. Yeah. So at this point in 2020, you are thinking, you don't have the hindsight of what happened here, yeah? But you're thinking, what should I do? Should I invest in this India bond that's offering me 5.75% and US is only offering 0.6%? You'd be like, that is huge. It's like more than 6-7x. Let's just go and invest all my money in India. So that's what we just learned, right? We just learned that the domestic interest rate, United States, must be equal to the foreign interest rate minus the expected depreciation of the domestic currency. So now let's add to it what has been the historical depreciation of Indian rupee. At this point, it was average 4% every year. Even if you look at last 3 years rolling, 2 years rolling, 4 years rolling, 5 years rolling, you could say that on average, Indian currency rupee depreciates against the US dollar by 4%. Now with this additional information, Do you think 5.75 is better than 0.6? Well, we just learned that we would, we would convert that. We look at the ET minus 1 minus ET upon ET, which is 4%, is the depreciation of Indian rupee compared to US dollar. And so then what we'd have to do is we'd have to look at how much are we getting? We're getting 5.75%. And what are we doing it at the cost of? 4% depreciation. So we're getting 1.6% more, yeah, compared to United States. So if you look at this now, it's no longer 5.7, it's 1.6% in US dollar terms. Remember the US, UK, US example, similarly, US, India, US example, you get 1.6%. So you would compare 1.6 with 0.6, you're like, it's about 1% more. But then it's no longer 5.75, which is a huge difference, yeah? And if you factor in, so remember this, we are using the same formula here. This is the depreciation of the rupee. And if we apply this, or if we use this another approximation, which is you look at 5.75 you're getting minus the 4% depreciation, you get 1.75, which is very close to 1.6% that we just did with this formula. So this is this, and this is an approximate way. See, in a sense, you find out, oh, I'm getting 1% more, but then you have to take all of this risk of currency conversion back, and you have to think about political risk associated with it. You have to think about the economy, how it will do in the future, the inflation, and all of that. So then you'll be like, hold on, this is not enough return for me to actually take this risk. So this is what helps. This understanding helps us make better investment decisions to find out where should I be investing, domestic or foreign, even if there is a foreign open market. But that situation now has changed quite a bit. Assuming now you're here in February 2025, the United States is giving you 4.4%, and India is giving you 6.75%, assuming 4% depreciation. What do you think is better? Which one is better? Yeah. So this would be 6.75 minus 4%. And so that would be around 2.75. Yeah. So you're getting 2.75% return, assuming a 4% depreciation in India, whereas you're getting 4.48% in US. So would you invest in India or would you invest in US? Well, the answer is pretty clear, that there are various factors that it depends on, but the relative yield is much higher in the US right now compared to India. Just with this one data point, looking at just this isolated way of one factor. There are so many other factors you have to look at to make this conclusion. All right, so that brings us to the end of openness in goods and financial market. Remember, openness in goods market allows people and firms to choose between domestic goods and foreign goods. And when they do that, they're looking at nominal exchange rate, real exchange rate to find out how much am I getting real items. And then when you look at financial market, investors can invest in assets that produce returns domestically or foreign. And then that depends relatively on the return, but also on expected appreciation and depreciation of domestic currency. Yeah, so that's the two aspects to figure out. And if we can do that, then we are able to think through and use the concepts that we've learned in the open market, because these choices are many. Yeah, domestic versus foreign, which fund, what asset, and what good to buy here, or competitive good to import and then use that, right? So this helps us gives us a good framework to think through and make better decisions. Thanks.